Welcome to Stress-Free Finance. I'm attorney Anthony DeLuca. On today's show, we're going to have John Restrepo from Restrepo Consulting Group. He's an economic forecaster who specializes in what's going on in the economy right here in Las Vegas. It's going to be a great show, so stick around.
From our studios in Las Vegas, this is Stress-Free Finance with Anthony DeLuca.
So on this week's question and answer, we got a question from John. And John wrote in and he had a question I get asked all the time, and that is whether or not he should file for bankruptcy. So a lot of times people just don't know whether they have enough money to continue to pay their debts or whether they should just decide to make the financial decision to file for bankruptcy. Now the starting point is to find out whether you actually have any income left over at the end of the month to pay your debts. Obviously, if you have no money left over, then you can't pay so much as the interest, yet the principal on your credit cards or your other unsecured loans. So the first starting point is to find out how much is it that you make. And the way you do that is by sitting down, taking a look at your paychecks, take your gross income, minus your taxes and minus all your deductions, and look at your net pay. Once you've established everything that's coming into your household from you or you and your spouse, or even from rent from a roommate, the total amount of income coming into the house, you put that in one column. That's your net income. And then you figure out your expenses. Now, most of the time when people try to figure out their expenses, they look at the major expenses like their rent or their mortgage or their car. But that's not really where the important details are. The important details are all the money that they don't realize they're spending. You know, the lunches during work, the going out for a drink after work, all the little expenses that add up. So what you have to do is just have to sit down and calculate all of your expenses, not just your rent and your car, but what you pay on your insurance, how much you spend on gas, how much you spend when you buy lunch every day, when you go to work, everything down to the last detail. What you spend on recreation, what you spend on food when you go grocery shopping. After you've totaled up all those expenses, compare it to your income column. Now, if your expenses exceed your income, then you have your answer. It's impossible to pay off your credit cards if you can barely make the payments on your basic necessities. If there is some money left over, you have to figure out whether the amount that's left over is enough to cover even the interest on your debts. So if your basic payments for all your minimum payments on your credit cards come out to be $500 a month and you only have $150 left over, obviously it's a mathematical impossibility for you to pay off your debts, and you should at least consider the potential of filing for bankruptcy. So we have John Restrepo from Restrepo Consulting Group on the show today. Welcome to the show, John.
Good morning, Anthony. How are you?
So John, you're an economic forecaster.
That's correct.
So why don't you explain to the people who are watching, what exactly do you do as an economic forecaster?
We typically look at chicken bones, throw them on the table, and that's how we kind of forecast the future. But no, seriously, what we do is we have a group of economists that work in our firm. We look at all the data, we look at the trends, we have all these econometric models, and we try to use those to forecast where the economy is going. And in our case, we also do a lot of work in the real estate industry, so trying to forecast where the real estate markets are going as well. So as you can imagine, in this kind of recession, that kind of forecasting has become kind of challenging, and so, but that's our job.
Now, you don't do that on an individual basis, like say an S&P or a Moody's, where you're analyzing individual
stocks. No.
Right.
When we look at the macro trends, we look at the GDP. We were talking about that earlier too. We look at general employment trends. We look at housing prices, commercial lease values, and all those sort of things. So we're looking more at macro as opposed to individual stocks, or just within the kind of the investment community. Although a lot of the companies we look at, a lot of the markets we track, do have a stock component. Because for example, a lot of the home builders or publicly held companies. So we do look at their stock performance, how they're doing, but we really are tracking more the market indicators.
And what areas of the country do you primarily do that in?
In Nevada, primarily Nevada, California, and Arizona.
Okay. And when you came out in 22 years ago, what was the growth like in Las Vegas here?
It was just the beginning of the boom. '88 was the first year, if I remember correctly, where they built about 18,000 apartment units in 1 year. Mm-hmm. So that was kind of just the beginnings of something different happening in Vegas. And it just continued that growth year after year after that. But the really high growth period was, I'd say, 95 through 2005. That's when the credit markets changed and a lot of the big resorts got built and everyone discovered Vegas, so to speak, and everyone wanted to have a piece of Vegas. So that last 10 years before the recession was kind of what I call the gilded age of Vegas, where you really saw that hyper growth that we're now dealing with.
Now, going back to '88, were the same basic type of industries that existed? Was it construction and gambling, or were there any different elements to the
Pretty much. If you look at the distribution of jobs by industry, it hasn't changed dramatically. Within the resort industry itself, it has changed dramatically because the resorts have become more diversified, so to speak. But generally, if you look at those statistics, we haven't changed dramatically. So gaming at one time was a third of all jobs, and now and it went down to 25% of all jobs. So it's pretty much stayed the same. We have not a really diversified economy yet, as we've traditionally defined diversification. So yeah, it's pretty much the same. We have not done a whole lot in terms of economically developing the community, and that's part of the reason our recession is so deep here, because we didn't have a broad economic base. To be honest with you.
And I don't know how to even put this the polite way, but it seems that we have a certain amount of deficit of education, of highly educated people here, college educated people
Right.
here. Our workforce in terms of the West is probably one of the states that has the least number of college graduates in the workforce.
That's correct.
Do you think that that's one of the impediments for our city and for the state to grow into other industries, just a lack of talent?
Well, there's two things. Yeah, I think because of a lack of diversification, a lot of folks that go to college here, or go to college that are from Nevada, go to college in other places, don't come back. And then they go to college here, let's say UNLV or UNR, they leave because they don't have the economic opportunities here, because we didn't diversify the economy. So that's part of the problem. The problem is we don't have a diversified economy to employ those college graduates that
Right.
leave, so therefore it kind of feeds on itself. A couple of other things too that I'm concerned about is the resort industry is the driver of the economy, yet they don't require high school degrees.
Right.
That's another challenge. So the culture of education issue. And third, although it's done very well for us in tourism and convention years, the selling of Las Vegas as Sin City, so to speak, does have an impact on certain companies moving here. So you start layering those different things, we are where we are today, where we're not a very diversified economy, we have a significant amount of brain drain, and we're starting to finally deal with these issues, and we have a tax structure that's not meeting the needs of the community, because we don't have a diversified economy. So it's all kind of melded in together.
Yeah, another issue I think is really difficult for Las Vegas here is that this is unlike any place in the country, in that people with no college education, no high school education, can drop out of high school and get a job making $50,000-$60,000 a year.
Right.
I mean, there's kids who are in high school saying, college, why should I go to college when I get out and the average starting income is going to be $36,000 when I can go be a bartender in one of the nightclubs, make $60,000, bring home $800 a day in cash, or not that it's a recommended career, but we have females are saying, hey, I can go work in a strip club, make $2,000 a night. I mean, I think that's one of the big problems we have here with why we have such a high dropout rate, and also why people aren't that interested in going to college.
It's interesting that you mentioned, because I absolutely agree with you that during that growth period that we saw, particularly that 95 to 2005 growth period, what you just said really held true. It was a disincentive to get an education because you didn't have to, because your friends that weren't getting one, they were doing fine. So there was a culture of the quick buck, so to speak, not investing in yourself for the future. I think this recession has changed a bit of that. How much it's changed, we don't know. I don't think the resort industry that drove a lot of that demand for that kind of employee is going to grow out of have a V-style recovery. It's going to go very, very, very slowly. Even the guys on the strip say no new projects for the next 10 years. So if that's the case, maybe that disincentive has somewhat gone away. One of the benefits, I guess, of this recession is a lot of people going back to school. I know there was an article in the paper today, community college, they were turning people away at CSN because they can't get in. So maybe it takes these hard times like this, these recessions, these tough periods to change behaviors. And that's what I'm hoping for. That not that those recessions are a good thing, but it changes behavior, and people get focused more on the culture of education and investing in themselves in their future.
And how long do you think, is a general proposition? I mean, obviously we can't have any exact numbers here, but how long do you think it'll take before the economy in Las Vegas starts to recover?
It depends on how you define recovery. If you define recovery like I like to define it, which is job growth, it's going to take quite a while. I think we're going to see a period of at least 5 years with pretty elevated unemployment. And when I say elevated, double-digit employment. It may not be at the 15% we see here today, maybe 11 or 12, but it's not going to be 5 or 6.
Okay.
So before we get to that long-term trend number, it's going to be 5 or 6 years before we start trending down back to 5 or 6. So it's going to be a long haul.
The numbers I've seen are that the unemployment rate is 14.3%. That's the last I've seen. Maybe you've seen
At the state level, I think. It was a little higher in
yes.
Clark County. Right?
Yeah. And what is the figure you have for Clark County?
About 14.9 or 14.6.
14.9.
It goes up and down. But remember, you got to be careful with the unemployment rate. It can give you a false reading, positive or negative. We like to look at month over month, year over year job growth. And that's where it's very constrained at this point. We're just not producing a lot of jobs.
But now, what a lot of people don't know is that when people stop collecting unemployment, they're no longer counted in the unemployment rates.
That's correct.
Now, I find that to be amazing. I think it's a statistical manipulation. But, well, not only why do they do it that way, but what do you think the real unemployment rate is? Because just because they've fallen off the payroll, off the unemployment rolls, doesn't mean they're now employed.
Right.
So, I mean, first let's start with the question of what do you think the real unemployment rate is? I mean, and if we also have to take into consideration that there are people who want to work full time who are working part time, who once were full time but now been reduced to on call. Right. So, you know, it's not just looking at the unemployment number itself and saying, well, it's 14.9%.
Right.
We have firemen and policemen who are used to making all this overtime who are not making this overtime, and they built their lives around a certain lifestyle, and now that that's been cut, well, yeah, technically they still have employment, but they still can't make their bills anymore.
That's correct.
So, I mean, what do you think the real unemployment rate is? Is it 20%? Is it 22%?
It's north of 20%, 20, 22%, something like that. When you factor in the two other components of unemployment, there's the unemployment rate you see quoted in the paper, the published unemployment rate. And then for, you know, kind of data geeks like us, we look at two other pieces. That's discouraged workers and forced part-time workers. And that group, and we're probably north of 20%, 23% at this point. But that's just part of the story. The other part of the story, and you touched on it earlier, is when your wages are cut, you have less money to spend. You have to prioritize more. It's harder to pay your credit card bills. One of the problems in this boom, one of the things that drove this boom was not just general economic fundamentals of wealth, was cheap and easy credit. So everyone got very leveraged, whether it was businesses or individuals. And so now, as a bankruptcy, you're seeing this in your own practice. So not only do you have to have job growth or feeling that you're not going to lose your job, you have to start paying off debts. Yet there's a lot of whole savings thing going on before you go back into doing a lot of consumer spending, which is good and bad, right? Consumer spending is good for the overall economy, but bad for the household if they overspend.
Right.
So there's all these forces in play right now, and we just don't know where it's all going to settle completely at this time.
Well, that's definitely a topic I want to talk about. But one thing I wanted to ask you is, how do these jobs come back? And if we're limited here in Las Vegas with regard to the gaming industry, with regard to construction, and there doesn't look like there's going to be a whole lot of construction moving forward. So this 22% unemployment, how does that get better if there's no place for these people to go? I mean, if there's not other industries for us to grow into, how do we really take a big chunk out of it, get it back down to some sort of normalcy at 5 to 6%?
Well, in the short term, we have to essentially wait for the national recovery to take hold, and it's starting to take hold. Consumers are starting to spend more. Consumer spending is starting to improve. It's not necessarily improving in discretionary areas. That's what we offer here in Nevada. In Nevada, it's discretionary spending. They're buying other things first. But sooner or later, discretionary spending comes in. They start coming back to Nevada and start spending more and all those sorts of things. Then that boosts the economy here. That's the short-term answer, just getting the consumer nationally to be healed again, to go get, the cure from the sickness he's had. The longer-term issue is, what do we need to do strategically for the state to diversify the economy? That's not going to come close. That's not a short-term answer. Is what do we need do now to invest in infrastructure, not only physical infrastructure, but socioeconomic infrastructure, which is the universities and higher education system. How do we structure the state's tax structure to accommodate a more diversified economy and attract other companies here? How do we change our image in many ways? So that's the longer term. The shorter term, we have to wait for the national economy to recover. It's not too much we can do there. We just waiting at this point.
Which, along those lines, one of the big concerns I have is we have a $14 trillion economy in the United States, or at least did.
Right.
How do we get people? I mean, really, a lot of that is built upon discretionary income, upon disposable income that the families have. But if they don't have access to credit cards because of the stricter lending standards, and they don't have any home equity lines of credit to tap, and they're unemployed, then it seems like this just downward spiral where it builds on itself. I mean, if they don't have the money to spend on the economy, then how do we have economic growth? If we don't have economic growth, how do we create more jobs?
And that's why, while we're starting to see a recovery in the data, so to speak, on the street, on Main Street, kind of speak, it's not much of a recovery at this point. It's a very slow, plodding, 2 steps forward, 1 step back style recovery. The other component of that is small businesses don't have access to credit.
Right.
You know, it's a big deal for a small business to say, I paid my rent on time last month, or I'm only 2 months behind.
Right.
So there's all this issue of credit availability to very small businesses and the individuals. So that's not what you're seeing at the national level, because you're seeing these huge corporations with a lot of profits, and they have banking relationships and all these sorts of things. So they're doing fine. But it's that small business and the consumer that's still under a lot of constraints. So it's going to be a very long haul out of this.
Do you think that some of the economic data that's coming out is a little bit buffered or hyped? Like, I mean, for example, we talk about GDP growth. Now, we took $787 billion of our own money through that stimulus plan, and we injected it into the economy through all these construction projects. And then we turn around and say, wow, look at all the growth that we had. Well, it's not really growth. You know, it's like me having a business that makes $100 and I owe $110, and I take $20 out of my savings and throw it in and say, hey, look, we're profitable. You know, we're taking our own money and we're injecting it into the economy and then calling it economic growth. Isn't that a little bit different than private sector growth and real growth in the economy?
There's a big debate on exactly that issue. It's the Keynesian argument that you're using. The Keynesian argument says when the private sector is not investing for whatever reason, for either too much debt or the constrained demand, the only group out there left to spend is the government. So the government tries to gin up the economy, so to speak, gin up spending through infrastructure projects and all those sorts of things until the private sector recovery kicks in. That has worked more often than not. I know there's a lot of debate on this, but generally when there's no private sector spending, the only thing that's left is government investments or spending to kind of act as the bridge to the recovery to come in. But it's a lot, very controversial, the whole concept, because the conservatives say we should just let the economy heal itself and not postpone the inevitable. Let it clear out. The same thing with the housing market and all these sorts of things. Just let the markets take care of themselves. The problem is that kind of unfettered letting the market take care of everything causes a lot of collateral damage in the process that politically no one wants to do.
Going back a couple of years to 2008, the bailout of the banking industry. Let's start with the general question as to whether you think that was a good idea or a bad idea.
Well, it was pretty controversial, but I think the data shows now that the bailout worked from the standpoint that most of those big banks were able to pay back those loans, and it did potentially save the financial system. That's what we're told. So I think that's worked a little bit better. The car bailouts worked not as well, and the problem with the TARP didn't affect community banks. Those folks didn't get help. So that's the really big problem right now in my mind over the next couple of years, is the continued struggles of community banks we're seeing all over the country. There's a lot of defaults still occurring because a lot of the TARP money did not really help them. But from a strategic long-term standpoint, I think most economists would say as much of a bitter pill as TARP was, it did work to do what it was supposed to do.
Do you think it has any negative implications on the capitalist system as a whole? I mean, the basis of capitalism is you're a successful business, you thrive, and if you're a poorly run business, you fail. And when you have banks that are too big to fail, and they're running their operations in such a fashion that they probably deserve to have gone under. I mean, what impact do you think that has on capitalism and the faith of the people in a capitalist society?
Well, I think the problem was so big at that point that I don't think they could have done anything else. Now, that being said, my concern is now, and the Treasury is looking at this right now, some of the rating agencies are factoring into their rating process that they won't let the banks fail again as part of the rating. So that's providing an artificial component to letting the markets work now that we fix them. Now, if the ratings company factor in, well, the feds are always going to step in no matter what these large banks say. That's bad. So they're finding that out right now. That and I know the Inspector General for the Treasury Department is in there investigating a lot of this stuff, saying, listen, we have certain things in place right now that could lead to another problem because we're giving guarantees. And not only that, but this HAMP and HAFA and some of these other housing programs haven't worked very well either because of the way they've structured them. But yeah, you're right. There's a concern right now that too big to fail, which was a one-time thing, now it's become a permanent built-in thing into the economy, acting as an artificial stimulus, so to speak, or protection that shouldn't be there, a guarantee that shouldn't be there.
Now, just further so the viewers, explain what a credit agency like S&P or Moody's is.
Well, they rate the quality of the bonds that are sold and stocks as well, but primarily bonds. There's Moody's and there's Standard & Poor's and some of these guys. Fisk is the other one, and they do generally a pretty good job now. However, they participated in the mess before because they were being paid by the people that were rating.
Right.
As part of how their fees are generated. And so Standard & Poor's and Moody's, for example, really contributed a lot to the housing market collapse because they had a permanent a model that showed a permanent appreciation in housing prices of 5 or 6% a year into infinity.
Yeah.
And consequently, that they sold bonds that way, and they packaged these mortgages in this way, and all these investors bought all this paper, some of it really bad, the subprime stuff, on the assumption that housing prices would go on forever. And so they did contribute to a lot of this mess during this process. And to be honest with you, there wasn't the reason we got in this mess. I think in many ways the recession was as bad. It wasn't overregulation. It was not doing not policing the regulations we had, not enforcing the regulations we had. And so this idea that overregulation causes a lot of problems. Well, underregulation can cause a lot of problems too, and that's really been the source of the issues we're dealing with today.
Well, when you look at that setup, I mean, it just seems on its face to be so fundamentally flawed. I mean, to have the credit rating agencies be paid by the companies that are rating them.
Right.
You know, it's like me showing up for work in a lime green suit with an orange tie and saying to my staff, well, how do I look? I guess you look okay because, yeah, I'm paying their paychecks.
Right.
They're gonna, and it's the same thing with these rating agencies. I mean, on the eve of Lehman Brothers collapse, I mean, when it was game over, the day before they had a AAA rating on Lehman Brothers.
Right.
I mean, how is that? I mean, how can you possibly look at that as a viable proposition to have the rating agencies rating them as AAA, and the next day they collapse? I mean, they're just done. I mean, doesn't it reflect on the credibility of them? I mean, at all?
Well, we're knowing now the whole financial structure is pretty cancer-ridden, with a lot of self-interest and a lot of conflicts of interest and all these sorts of things going in place today. And that's why the Obama administration has tried to clear up some of these conflicts. I don't know if they're going to be successful. I think there are a lot of forces in play, whether it's Wall Street, whether it's the rating agencies, or the folks in Congress that have a vested interest in tweaking and adjusting and quote-unquote reforming, whatever that means, but not really making the fundamental changes that are going to prevent something like this happening again. That's what a lot of the economists that you read about and see, you hear are saying. This is, we're not really cleaning up the mess. We're dealing with things at the margin, but we're not putting things in place right now that could prevent something like this from happening again, particularly the conflicts of interest issue that you mentioned. So it's a real big challenge. We're not at this by a long shot at this point.
Now, what about if you look at the Dow Jones right now? It's around 12,000. I mean, I've always been a big proponent telling people that I don't believe in investing in the stock market, and of course you're going to have a different opinion with regard to that. But it seems to me that we're at a point where there's so much money put into 401ks and mutual funds that obviously if you keep throwing money at a particular stock or a mutual fund, it goes up in value, and there starts to be no correlation between the underlying stock value, what it's really worth, and what it's selling at. And we can go back to 2001 with the tech bubble. I mean, there's just so much money being thrown at it. You had things like Pets.com going to 400.
Right.
It had no revenue, had no receivables, had nothing, but it just shot through the roof. I mean, how dangerous do you think it is for people investing in the stock market when there seems to be no correlation between what's going on in the real economy and what's going on Wall Street?
Well, I think the stock market over time has, I think, proven in the long term. Again, everything you got to break short term. This is one thing that frustrates me a little bit sometimes when we have all these discussions, when I have them with other folks. Not you, Anthony. Never get frustrated with you. And that is sometimes we mix in long term and short term altogether. In the short term, the stock market can be pretty volatile, as can be any other asset group, gold, real estate, or anything. In the long term, the stock market has proven to be a pretty accurate barometer of wealth over time. That being said, it does have to be based on economic fundamentals. You can't have a stock market that's based on expectations. You mentioned earlier the dot-com bubble, which is interesting because it's what happened to the dot-com bubble that created the real estate bubble. Everyone fled from the dot-com stocks into quote-unquote a very conservative asset, real estate. You can't lose your real estate. You got your house, you got the building, you got the land. You can see what happens there. So real estate's pretty volatile too. It goes down to understanding the expectations of what's going on in the underlying economy when you're making your investment decisions. Some people get so wrapped up watching these investment gurus on TV without really understanding what's happening on Main Street and what's happening in the real economy below them. And the stock market can go a variety of different ways. The hottest thing now is gold. Everyone wants gold now, and who knows how long it's going to like. I remember in the 70s, they wanted to buy Krugerrands, if you remember those
Yeah.
gold coins from South Africa. That was the big thing. So these things come in waves periodically, at the end of the day. But it's like anything else. You have to have a balanced portfolio of, certain commodities, real estate is, and certain asset groups and stock. And you just got to manage those and understand them a little bit better, but really understand what's going on in the economy.
But I guess that's really leads into what my whole point is. There's so much money in these mutual funds that no matter what they all decide to flood into next, whatever the pick of the week is,
Right.
that becomes a bubble. I mean, look at gold. Gold was if you go back just, let's say 8 years, I mean, gold was around 450. Now it's, what, 1,300,
Right.
somewhere in that ballpark? I mean, it seems like no matter where they choose to be the next great investment, that just becomes another bubble. And it seems like the little guy always gets in on the tail end.
Mm-hmm.
When you start hearing your barber and your taxi cab driver giving you stock tips and tips on buying gold
Mm-hmm.
and tips on real estate, then, it's time to get out.
Well, that goes back to what you were saying earlier, and that is, in a free market, this is the problem with capitalism to a certain extent. It's prone to booms and busts. That's why regulations come into play to try and mitigate or limit those peaks and valleys. And so the pendulum swings. You get these huge booms and busts. The regulators come in, and the pendulum swings one way, and you get over-regulation, and the markets get constrained. They don't react properly because now they're over-regulated. So the regulators pull back after a few years, depending who's in the Congress, and you have the more free market forces come into play, and they create the boom and bust cycle again. So I don't know if it's ever going to get cured, because it's kind of the nature of the over-regulation versus under-regulation versus the boom and bust cycle. They're all kind of mixed in together. We're always trying to find some kind of balance. It never seems to happen. So in my life, it hasn't happened. So I'm not sure when that's going to happen. But all you can do is monitor things and try, pay attention. The good news is with Google and the internet and all these sorts of things right now, consumers are much better informed now. Hopefully, I think, unless you listen to some of these guys. But at least there's more information out there. Sometimes too much information.
Right.
But at least you can, if you have a certain mindset, strategically look at your information, be careful what you look at, be smart about it. But at least, on balance, probably more information to the consumer is better than less information, although some of that consumer information may be bad. It's better than having nothing.
Right.
Because I don't know if you can trust the experts, your stockbroker or anyone else, because they didn't predict any of this stuff either. So
No.
you might as well take care of yourself, I would imagine.
All right, well, I appreciate you coming on the show, John.
Thank you,
It was
Anthony.
great having
Always
you.
a pleasure. Call me
Fun.
anytime.
You bet. As a final thought, for the next 2 weeks, I really want you to focus on where you're spending your money. And the way you do this is you carry a little notepad around with you, and I want you to write down everything you spend money on in the next 2 weeks. You'd be amazed at how much money you can spend and how much wealth you can build just by paying attention to the expenses. For example, that morning cup of coffee that cost you $4. Well, instead of getting your double espresso mocha latte, if you were to take that $4, put it in a savings account, every day from the time your child was born until he was 18, you'd be able to pay for half of his college. If you don't believe me, get a calculator and do the math. Well, I appreciate you tuning into the show. Have a great week. Fight the good fight. Don't let corporate America get you down. If you have any questions or thoughts, go to our blog, and we'd be happy to hear from you. We'll see you next week.